Joining us now for an exclusive interview is Alcoa CEO William Opplinger, along with our Morgan Brennan. Morgan.
Hey, it's good to be on with you guys.
Great to have you.
Bill, it's great to have you on the show, especially before you speak to the Wall Street community here, too. We just talked about it, a miss on the top and bottom line. You've seen some impacts here from this war in the Middle East. On the one hand, you have aluminum prices at multi-year highs. On the other hand, your ability to move alumina and bauxite through the Middle East right now is being hindered. So how would you lay out the quarter, and what does it mean for the rest of the year?
So Morgan, it's so good to see you again, and thanks for having me on. When we consider the quarter, we essentially met the expectations that we had laid out in our outlook and met our own internal expectations. The quarter was strong from a safety perspective. Operations were strong, even in light of the conflict going on in the Middle East. We delivered $600 million of EBITDA. We executed on our strategic initiatives, and we're guiding to a stronger second quarter. And so even in the face of some of the difficult conflict issues that we've seen, we delivered a pretty good quarter and are expecting a better second quarter.
Yeah, I realize there's a lot of uncertainty here, and you have a market more broadly that's being moved by every headline regarding the Strait of Hormuz. But in terms of what it means for the aluminum markets globally, what is your outlook? And even if you were to get the Strait opened today or tomorrow, how quickly can that normalize?
So the conflict is having, as you can imagine, a massive impact on the aluminum industry. So if you step back, close to 10% of the production of aluminum in the world is inside the Strait of Hormuz. So that's roughly 7 million metric tons. Around 2.5 million metric tons of that has already come offline. What that means is that we're seeing a very tight aluminum market. It started the year tight, and with those curtailments, it has gotten tighter. However, as you noted, we have a big alumina business, and our alumina customers, some of those sit within the Gulf. We've been working with those alumina customers to make sure that we reroute that product outside of the Gulf. But at this point, we're not seeing any alumina go into the Gulf.
In terms of how long you think this tight situation will last, Bill, I'm curious. JP Morgan just had a note out today outlining what they think will be the impact based on the 2 Iranian strikes on the 2 aluminum sites in the Middle East, saying that those sites, even if you were able to start today, won't be restarted for 9 to 12 months. What do you foresee in terms of where we go on price specifically, given where we are now?
So prices today are up around $500 a ton versus what we achieved in the first quarter. So prices today are up over 15% versus what they averaged in the first quarter. I think those analysts are right that if the conflict were resolved today, it will take up to a year to restart some of that capacity, and potentially even longer. As I said, we started the year in a fairly tight market environment at the beginning of the year based on a couple of curtailments that had occurred around the world, not ours, and strong aluminum demand. Now you have 2.5 million metric tons that have been announced coming offline. And every day that goes by with this conflict, the remaining 4.5 million metric tons of capacity becomes more at risk within the Gulf. All right, and so what we're seeing is that we really fundamentally believe that within the U.S. market specifically, many people are underestimating the tightness that we're going to see in the May-June timeframe.
Bill, given what's happened with prices, are we in the zone of having to talk about demand destruction or substitution, or is that not really in play?
It's a great question, Mike. And what we're seeing today is actually a pickup in orders. And so it is very difficult for us to bifurcate the strength of the order book that we're seeing today that is based on the fact that people have to reroute, or our customers have to reroute supply chains that were in the Middle East, and they're looking for alternative supplies. So again, you see the strength of the second quarter that we're projecting because we're picking up a lot of orders. And then, at the beginning of the year, we saw demand being fairly strong. We continue to project, even today, that demand growth around the world for aluminum will be in the 1% range. But for us, we're starting to really see a pickup in short-term orders and for orders for the entirety of 2026 based on supply chains that have been disrupted.
Bill, we're having this conversation, and in the background, you still have tariffs here in the U.S., and you just had those Section 232 tariffs actually amended. You talked about it in your earnings results about imports from Canada. How are you navigating it? And what does that mean in terms of your ability to build out more production here stateside amid this entire geopolitical conversation?
So Morgan, there's a lot of questions built into that statement. But let's go back to what I've told you for the last 2 quarters. Building capacity in the United States is really going to be based on low-cost energy. And at this point, we don't see opportunities to build in the U.S. greenfield capacity because we can't get energy at the level that we want to get it at. With the tariffs that are in place today, we're paying over $1 billion of tariff costs, but that is getting picked up on the revenue line because that price is getting transitioned to our customers. And so we continue to bring metal in from Canada and fulfill orders in the U.S.